Later in life, even a ways into retirement when you're truly financially independent, there's a few different investment strategies that may be appealing to you that aren't right now. What are those? I've got that and more coming up. My name is Mike Bernard. I'm the host of The Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The investing approach up the mountain is going to be different than how it should be coming down the mountain. That's right. When you're accumulating and when you're saving up for retirement, risk is your friend, actually, and you might not think that, especially, right now as we're feeling a little bit of risk after the stock market's been on a 5-month tear. Risk is actually your friend. If there wasn't risk, then there would be no risk premium. There would be no return. There'd be no reward and benefit. So you want to have a prudent long-term investment strategy that will go up and down. And as it goes down, you want to continue to contribute and buy more shares at those lower prices, because you need to buy shares when the price is low and have them grow over time, and like the stock market has inevitably done over a long period of time. That's how you climb the mountain, taking the appropriate risk tolerance, a strategy or strategies that you'll stick to, but yeah, leveraging and using risk. But then the way down the mountain, as you're living on some of these assets in retirement, you said goodbye to that paycheck and you're starting to use these dollars to supplement Social Security and for retirement income. Often you need to take a slightly different approach. We call it a personal pension plan, and that is where you're looking at how much money do you need in the short term, and let's have those dollars invested in short-term instruments. How much money will you need sort of right after that, intermediate term, and have those invested for that level of risk and for that time horizon. And then any dollars that you don't need for 8, 10 years and beyond, those should be fighting inflation, which is going to, I used to say sort of the silent killer, the slow temperature rise in that pot on the stove, where you just can't tell it's there, but it is there, and it erodes your purchasing power. Right now, it's there. Everyone knows it's there. We feel it. But your retirement's going to last decades, and you want dollars to be fighting inflation. That's those long-term dollars. That's for most people. That's for most of us. That's the approach that we take. But there are times when on your way down that mountain, you have sacrificed, you've saved up enough resources that you get to a point where you say, yeah, there's really, it's very, 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 very unlikely. I don't know how many varies to include there. Unlikely that we're going to use up all of this money that we've saved up. And this isn't every financial situation, absolutely not. But seeing in these scenarios, a different investment philosophy, a different investment approach become more appealing. And I've seen folks fall into one of three camps. And this isn't, well, at 62, I'm able to retire, I'm financially independent. Absolutely, I would agree with that. And therefore, I'm going to take one of these three approaches. No, in reality, while it's possible, depending on how much resources you've amassed, normally this is, well, we're ways into retirement. We're in our late 70s or around 80, and yeah, the portfolio's done great, and we're not seeing a lot of big changes in our spending or big, huge purchases coming up, and so we're sort of maintaining, and we've got this wealth built up, and that is typically the recipe or the season when a different investment philosophy begins to resonate. So what are those? And your certified financial planner, regardless of which of these three might feel most appealing, your CFP is supposed to be and will be objective to, okay, well, what's appropriate for your situation? Weigh the pros and cons, help you plan through it, both from a tax standpoint and cash flow, a legacy standpoint, estate planning, all that sort of stuff. But the first investment approach is one that invests for yield. So again, this isn't right at retirement. This isn't right before retirement. This is a ways into retirement where you're done with big financial decisions and changes and more have plateaued. And at this point, this is what it often feels like. Okay, we've got about $5 million saved up. We probably only need 10 grand a month from our investments. And so therefore, if the total portfolio can yield, 3%, we're comfortable with that. We're comfortable. That'll be enough income to cover taxes and give us our 10 grand a year, we're comfortable with that, and therefore let's just invest for yield. It's going to cover the nut. It's going to cover the amount that we need to draw, and therefore let's just build a safe strategy, a comfortable strategy that covers that. Now, 3%, and I'm just using that in this scenario. Oftentimes, when you're investing for yield, you're not keeping up with inflation, depending on what you're using. You might think, well, yeah, I'm going to use the S&P 500. Well, the S&P 500 recently, the yield on the S&P was around 1.3. That's near a record low. The record low was closer to 1.1, 1.12, I believe, back during the tech bubble, right before the bubble burst, where stocks had gotten so inflated, there were so few dividends that the dividend yield was so low. It's very low right now, and so yes, stocks and the S&P 500 will keep up with inflation, actually surpass inflation over the long term. Historically, that's what it's done, hand over fist. But the yield on it is typically not enough for someone to say, well, that's going to fit nicely. So normally this is investing in instruments that are lower risk, maybe not all low risk, because it's not an emphasis on low risk. The emphasis on, well, let me just get a steady yield, a steady income that covers what I need, and then some, so I'm comfortable, and that's fine. So that's one approach, invest for yield. The second is sort of in line with that one, or maybe where you were thinking, and that is just, I want to invest for safety. I want to invest for safety. And I'm hearing more and more people feel that way right now, as we've got an election year, and stock market has value from a valuation standpoint is gotten a little ahead of its skis here. And so valuations are a little high, and folks in this camp, late 70s, early 80s have seen a lot of risk, and they look and say, I'm not going to spend through this money. And I would much rather be able to sleep at night than worry about eking out extra return. And so this goes from, hey, I don't need to be swinging for the fences, to I don't even really need to hit singles anymore. We can bunt. We can bunt. And so that is taking an approach where you're looking at, FDIC insured instruments or treasuries, and it's not just about yield, because in these situations, maybe they're not even drawing from their investment portfolio. They've got enough income sources, covering all the income that they need, and it's just about, well, how can I'd rather not see any volatility or much volatility in my investments, and I just want the dollars to be safe. Now, again, I'm not arguing for, well, this is a good approach, or when you reach a certain level, you should just invest for yield, or you should just invest for safety. Just seeing it with folks that reach that sort of level and plateau. If there was one of the three approaches that financial planners or myself tend to gravitate more, it's the third one, and that is invest for time horizon. And if that's the case, then again, it's been, well, we retired and we built out this personal pension plan, and now we're a decade or 15, 20 years into retirement, and the portfolio continues to grow. We're getting enough income from it, or we're not seeing big draws coming or demands on the dollars. Therefore, what should we do? And this is the one that I gravitate towards, because it's, well, what's the time horizon then? The time horizon should influence and help dictate what the investment strategies are. And that scenario, well, yeah, we're only drawing out a little bit. Okay, well, let's keep that little bit safe, or let's keep enough in safe dollars or earning a yield that it provides that level of income. But the rest of the dollars, if these are dollars you're not going to touch for the long term, or maybe not touch ever, let's invest them as if they're long-term dollars. And that will continue to, go up and down with the overall markets and long-term strategy that makes sense. But that's the way for families to build more wealth and build more generational wealth. That's the one that tends to make the most sense for us at aligning the investment strategy with the time horizon. If you're on track to possibly be in this scenario where you're saving aggressively and you're building up your financial house, and it's likely or it's possible that as you get into and through retirement, you'll reach a point where we're actually, the portfolio's doing just fine, And financially, we don't have big demands or draws from it. Therefore, what should our approach be? Objectively, work with your CFP. Talk through the different range of choices, whether it's just these three or a combination of them, and find the right strategy that fits for your situation. Again, this is investment strategies, which is one of the 6 areas of your financial life. So you still have got to look at your present financial position, protection planning, tax planning, your long-term retirement and legacy planning, and estate planning, right? So you've got to look at how these investment decisions fit within the entire context of your financial life. So you got to work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.